Welcome to the Lean Solutions Podcast. This is the podcast that adds value to leaders by helping you improve performance using process improvement solutions with bottom line results. My name is Patrick Adams, and this season I'll be joined by three other amazing hosts, including Catherine McDonald from Ireland, Andy Ulrich from Australia, and Shayne Daughenbaugh from the United States. Join us as we bring you guests and experiences of lean practitioners from all over the world. Hello and welcome to this episode of the Lean Solutions Podcast. My name is Patrick Adams and I'm joined by one of our second hosts, Shayne Daughenbaugh. Welcome back, Shayne, for another amazing episode with an amazing guest.
Thank you.
How you doing?
I am doing well. It is spring currently at the recording of this, so this is the time that my heart is happiest. Love this time of year. So I'm doing well, thank you.
Love it. Well, today we are joined by our guest, Mark DeLuzio, and Mark is the founder and chief executive officer of Lean Horizons Consulting. He's also a former corporate officer and vice president of Danaher, of the Danaher business system for Danaher Corporation. Danaher, if you're not familiar with Danaher, they have been recognized as the leading implementer of Lean globally in many different aspects, and they've been rated as the third most profitable U.S. stock over a 30-year mark. But Mark is credited with developing the first lean accounting process in the United States for Danaher's Jake Brake division, where he served as their CFO. Mark is also the author of Turn Waste into Wealth, which offers practical advice for those considering a lean transformation. And then also he authored Flatlined, Why Lean Transformations Fail and What to Do About It, which offers some lessons learned from Mark's association with hundreds of lean transformations on a global basis. So we have an expert in the midst, and we're excited to dive into a topic here with Mark. First, Mark, I want to welcome you to the show. So welcome.
Glad to be back, guys.
Yeah, no.
Thank you. Yeah, I've noticed Shayne taking on a new role with you, Patrick, and been listening to your podcast, and it's been fun to listen to all this. So you guys are doing a great job. Keep doing it.
Well, I appreciate that. I went back to you were on the show, Mark, back in season 2, and I was listening to that episode myself, just catching up on the Danaher business system and some of the conversations that you and I had. And as I got to the end of the episode, we said, hey, this lean accounting thing or traditional accounting, problems with traditional accounting, why lean accounting is so important. We said, we need to get back together and do another whole episode just specific to traditional accounting versus lean accounting. And I'm like,
Sure.
we never had Mark back. So here it is. We're finally back together.
Well, I will tell you this, Patrick, if you're listening to my podcasts, you should see a sleep doctor. You must have sleep apnea or something to try to get to sleep. Anyway, no, that's true. Yeah, we did say that. I do recall that. So glad to be back and help you guys out and get the message out, right? That's what we're trying to do.
That's right.
I'm excited about this topic, Mark, because I really know nothing about it. So if you could, for those of us that are, new to the room here in this space of lean accounting, can you give me kind of what's the difference between traditional cost accounting and lean accounting? I am not an accounting, banking, money expert whatsoever. I pay people to do this kind of stuff. So give me an idea of how this is different. What's with lean accounting?
Well, first of all, embarrassingly, Shayne, I have to say that what we call lean accounting is remarkably simpler than what we call traditional cost accounting. I grew up as a cost accountant. I worked for companies like Lego and a typewriter company, believe it or not. Some people out there may not know what that is. And a blasting products company. And I worked for some unbelievable cost accountants. And I was a pretty damn good cost accountant myself. But it seemed as if the only people who understood cost accounting were the cost accountants. And even there, you had a bell curve. When it got to the CPAs of the world and the financial types, cost accounting scared them because they just didn't, it was something that if you don't really do it and live it, you don't understand it. Well, therein lies the first problem. Nobody understands it. Okay. Secondly, traditional cost accounting, Shayne and Patrick, drives on lean behavior. So here I come into Jake Brake, which is the legacy company for Danaher, where I came in as a senior cost accountant manager and eventually became their CFO. And as I got sent to Japan in the late 80s and started working with Shingijutsu, and all of this percolated as the foundation for DBS, the Danaher Business System, I started seeing the things that we were doing in an accounting perspective that were driving the wrong behaviors. Okay. All the things that we measured and applauded ourselves on were just driving us to go the wrong way as it relates to lean principles. So, for example, I'll give you two examples, and there's many. Absorption accounting. Fundamentally, absorption accounting means that I'm going to capitalize all my production costs into inventory, all right, and only expense them when I either sell the product or if I, well, the other way it comes out is obsolescence, right? If it's spoiled or whatever. So there's an incentive for manufacturing to produce as much as possible because their absorption variances will look favorable. Well, what does that mean? If I'm making products A, B, and C, there's no incentive for me to change over and get really good at changeover to go to B. I'm just going to make a bunch of A's because my absorption variance is going to look really good. That's one example. Another example is, which by the way, builds inventory, and we know that's one of the 7 wastes of Tasciono. I'll give you another example, purchase price variance to standard cost, which by the way, we eliminated all the standard costing. I'll talk about that later. What's the easiest way to get a favorable purchase price variance? If my standard cost is $1, let's say for a raw material, I tell the supplier, hey, I'll buy a gazillion of them at 90 cents. And as a purchasing agent, I look really good. I got a 10-cent purchase price variance. Well, now I just violated just-in-time principles. I bought more than I needed. Okay. I'm going to end up scrapping a bunch of this stuff because I bought too much. Or if my design changes and that component is no longer valid, I've got obsolescence, right? I also, and this is something that people miss a lot on this whole purchase price variance. When I tell a supplier to make a lot of part A, even though I don't need it now, I'm stealing capacity from that supplier to make part B. Okay. And now you say, well, geez, we didn't get part B from the supplier, so we couldn't ship. That's because the purchasing guys had them batch part A and consume all their capacity in that regard. And that's a missing thing that a lot of people don't think about. So again, just another one of those measures that are trying to do the right thing, in this case, purchase price variance, absorption variance, but drives absolutely 180 degrees the wrong lean behaviors. So what's the best thing to do in that respect? We 5S this and we get rid of them. Okay. I mean, we stopped doing it, right? And what we've done is gone more to actual costs and trying to drive cost to the value stream or the cell itself to the product. Now, here's another big difference, Shayne, that you asked. A lot of this has to do with how we treat overhead costs. Okay. And typically your traditional cost accounting process takes some arbitrary basis like direct labor hours, machine hours, whatever, and allocates overhead costs based on that basis, which has absolutely nothing to do with, in most cases, the cost absorbed by those value streams. So in other words, this is take an example, if I have $1 million of fixed costs, let's say it's building depreciation, it's salaries, it's insurance, it's all this stuff, right? And I'm going to allocate it based on direct labor hours. Well, if I have a highly technical cell with a lot of automation, they're going to receive less of that charge than a cell that has a lot of labor. It's totally a disproportionate allocation of those costs. So the whole idea here is to drive as much of your overhead cost directly to the value stream that consumes that cost. All right. And we did that and we reduced by about 80% the amount of allocations. So what we ended up doing is charging things like maintenance, tool room, all the related costs right to the cell itself.
Hmm.
And now people had control of their destiny, and all those costs were as closely matched to the product costs as possible. In a traditional environment, you've got this overhead percent. You know, you guys know probably, Patrick, from your engineering days. Hey, what's the overhead rate? Oh, it's 250%. And you just throw that on there, not even having any concept what that might mean.
Right.
Yeah, and that's fair, right? And it means nothing. So now we can say, hey, none of these costs are being allocated. They're direct charge to the cell. And by the way, if they don't make any sense, get rid of them, right? So I can tell you about more, war stories about how the accounting itself saved our company a boatload of money. Okay. So those are some of the fundamental differences between
So what
the two.
I'm okay, I can appreciate that. So what I'm hearing is, to put it in language that I'm familiar with, opportunity cost. You mentioned, using up an opportunity for part B with getting all of this for part A.
Right.
The unlean behavior of batching, having to batch certain things and those kind of that's kind of what I'm hearing. Can you as it sounds to me, it's almost like you're trying to simplify the accounting process.
In a big way.
Is that accurate?
Absolutely. Absolutely. And again, I told you earlier, it was embarrassingly, hey, tell me about lean accounting. It's so damn simple. It's embarrassing almost because everybody thinks it's some kind of big mystery. Okay. And it's not. It's a lot easier than your traditional stuff you learn in college. And I learned on the job, And there's a lot of different traditional thinking. And I think you probably heard me say before, the finance organization is usually a major reason why lean transformations fail. Okay. Because they're standing there with their clipboards and their calculators and green eye shades in the stands while people are in the arena fighting the lions and tigers. They need to be in the arena with them because they're part and parcel to the transformation. So a lot of people say, well, Mark, what do I do when the finance guys come to me and want me to justify my lean initiatives? My turn is turn the question back to them. Well, maybe you can show me a model of how you justified your finance group. Okay. Show me that. Show me how you did that. Because I don't know how to do this. You're the finance guy. So I'm sure you've done this with your own team. Show me how you justified that financial analysis, that financial analyst. Okay. They can't. Okay. And there's certain things you can't justify with dollars and cents. There's certain things you can't do. And so this whole business about I need to have accountability and a payback on every little thing I do with lean is a killer because you just possibly can't do that. I'm a pretty good finance guy. I can't do that. I'd never be able to justify on paper. I can make some numbers up. I'd never be able to justify on paper the value of doing 5S. Okay. There's absolutely no way. Just like you can't justify, Shayne, going to the gym and spending 45 minutes on a treadmill. I want to know the data now that changed in your body. But you can't. Okay. So does that mean it's the wrong thing to do? Absolutely not. So,
Mark, you talked about lean accounting versus traditional accounting, and you used some examples from your time at Danaher, specifically, looking at material prices and maintenance and things like that. So that for a lot of our listeners, I think that resonates. There's a large majority of our listeners that are in the manufacturing industry. I wonder about, those that are in, state and local government or nonprofit organizations or healthcare, is traditional accounting also, incentivizing the wrong behaviors or contributing to the wrong behaviors in those industries? And is there a different way that accounting can be looked at in those industries, or is it only, the manufacturing industry or?
Oh, no. It's a good question, Patrick. And I'll tell you this, the one thing that financial professionals have to get over the hump on is that how you organize your managerial reporting does not have to be compliant with any GAAP or SOX compliance or, financially, accounting standards boards. It doesn't have to be government compliant at all. You can account on the back of a napkin if you need to, as it relates to managerial accounting. The problem is we try to take financial reporting and use it to run the business. And that's a non-starter because the financial reporting that you get does not give you the granularity. First of all, it's looking in the rearview mirror, number one, usually 3 weeks late, but it doesn't give you the granularity to make decisions. So the first thing to do is get over the hump that your managerial accounting does not have to be compliant, okay, with law or anything else. You still need to do all that stuff really, really well because you have to report to the public or whatever it is, banks, whatever, financial institutions, Wall Street, SEC, okay. But as far as looking at the accounting in a nonprofit or in a service organization, the same theory applies. You really have to look at the numbers that are coming out of your financial system and ask yourself, are they driving the right behaviors as it relates to my stakeholders? Okay. My stakeholders being, well, the people I'm serving. Let's say you're a nonprofit. Well, the people who are benefactors of your nonprofit are your customers, right? Your employees are your customers for the nonprofit. You've got donors who, in a sense, are customers or stakeholders. So, am I doing the right things as those objectives I set for those stakeholder groups, or are my accounting measures and reporting moving me away from that and actually having me do the opposite thing? And that's what you have to look at. So it applies there as well. Absolutely.
Yeah, that's good.
Okay. So for those that, let's say traditional accounting, that are familiar with that, bless their hearts. And you're mentioning something that, hey, you don't have to worry about all of these things you just mentioned. Like, I imagine red flags are popping up. Like, wait, what? We were taught we had to worry about all of this. You're telling me we don't? Can you kind of bring that down a level and kind of explain to, if you were, as if you were speaking to someone who is traditional cost accounting, and working with, standard costs and all of those kind of things, how that contributes to, and you've kind of mentioned it, but how that contributes to dysfunctional lean behavior, maybe within manufacturing. And I love how Patrick said that, in other services as well. Like, how does this like really steer us off the boat? Like, we've been working with lean for a while. We're also using traditional cost accounting. What's kind of the clash that's happening in there in that sense?
Yeah, Shayne, one of the things that the financial community has to understand is that they cannot lead with this. They have to follow the changes that get made in an organization. So, for example, I had a company out of Florida call me one time. Hey, Mark, we want to do lean accounting. And I asked them like 3 or 4 questions and said, you're not ready for it. Because their organization was still working on MRP work orders, all push manufacturing. They had no value stream set up. They're still in functional departments. They were scheduling each operation independently. They didn't have that single point schedule that pulled through the factory. Okay. They were not set up to win, and the accounting has to follow that. Okay. The lean accounting has to follow those changes. So to try to do this without having the organizational change won't work. Now, the next thing, and probably more importantly, is, or equally important, is you have to have an enlightened leadership team that understands why this is. And most leaders don't have that experience. Now, I was lucky enough to have the air cover with Art Byrne, who's a good friend of mine. He was a group executive at Danaher, and George Koenigsegger. Those 2 guys gave me air cover. And matter of fact, I got an unbelievable negative report from Danaher's corporate auditor, who came in, who was very friendly and pat me on the back. Hey, this is great. This is great. Really like what you guys are doing. Our numbers were blowing the cover off the ball. And then I got this negative report of how draconian our system was, okay, and how it violated all these accounting principles. And this guy didn't understand that, as I said earlier, the accounting principles don't matter, because I'll give you one example. we charge actual cost to the cell. And one of the things I didn't want to do is that whole purchase price variance concept I talked about earlier. So I was able to break down product costs by product for every cost category, whether it be labor, tooling, supplies, machine depreciation, whatever. Well, one month, this operations guy's going, hey, Mark, my cost for tooling per unit went through the roof. I go, yeah. Well, let's take a look at it. Well, he bought 6 months worth of tooling. But Mark, don't you amortize that? I'm not going to be using that I'm not using all that 6 months worth of product this month. That's for 6 months. I got a good deal on it. Oh, well, good. The next 5 months, you're going to look really favorable. But no, this month, all 6 months of that's getting charged this month. But Mark, that's not fair. I know, but that's just the way it is, right? And from a financial accounting perspective, we'll amortize it, okay, if it happened to fall on a quarter, but not for a managerial. No, I don't want you buying 6 months worth of tooling, which, by the way, and I was right, the design change, that tooling was going to be obsolete. Let's go back to your supplier and negotiate a deal that you're going to take 1 month at a time or whatever it is. But no. So he went back and sent back 4 months and got a credit. And sure enough, that design change, that tooling would have been obsolete. Okay. So here's an example where, no, I'm not going to let you do unlean things. Okay. And yet my accounting did not match what we would put in the financial statements that go to corporate and that go to Wall Street. But I didn't care about that. I was trying to drive the right behaviors. All right. And this is a very good example. All right. So, but if you don't have the understanding of your leadership and getting through the heads of the financial guys that your managerial accounting does not have to match your financial accounting, then you're going to always hit your head against a brick wall. All right.
Yeah, it's a great insight on that. I love hearing that. And I was thinking while you were kind of wrapping up there about the traditional way that organizations determine price for their products. So they take their cost that is based on history. They look at it, how much time it takes, resources, all that stuff. They come up with some kind of a cost. And then they determine, okay, well, we should be making X amount of profit. So they add their profit onto that. And then that gives them a price, right? That's correct me if I'm wrong, but that's how I would understand traditional pricing models. Very simplistic, right? But in the lean world, we take our price that the market determines is the price based on the value that we're able to provide, subtract the cost, and that determines our profit. And it's our job to try to reduce our costs in order to maximize our profit. And it's a different thought process around how we should be, how our pricing model should be set up. Is that something that you guys looked at Danaher? Is it something that you talk about in your book? What are your thoughts on that whole concept?
You Patrick, you just hit on something that is something I've been fighting for 30 years now. Okay. And that whole market-based pricing versus a customer's not going to pay you for your inefficiencies. And how are they going to make that decision? By not buying your product because you're overpriced. Okay. There is a market value for what you have to offer. And this goes into another area which I want to talk about. But I've had this debate time and time again. And when I actually do have a client look at what I call a loss analysis on their quotes, okay, and we Pareto the heck out of that to figure out how all this works and why are we losing. The easiest thing a customer can tell you is that your price was too high. And many times I found that is not really the reason why they're not doing business with you. Okay. It's because your quality is lousy, your lead times are too long or whatever. But it's easy for them to say your price is too high, right? But in those cases where price is too high, I'll ask the question, are we market-based pricing, to your point? And they'll, without a doubt, 100% of the time say, yes, we are. And then the conversation will ensue. And before you know it, yeah, the reason we lost it is because our costs were too high. Wait a minute. I thought you just got through saying you're not pricing based on cost. Well, we're really not, but they are. Okay. Yeah. And so you just hit on something that's a real big deal out there, that everybody expects customers to pay them for their inefficiencies. And if your costs are 12% higher than your competitor, everything else being equal. Now, one of the other things I want to talk about is even in a commodity product, which I would define as the only differentiator is your price, you can beat people by differentiating yourself. I don't believe there is such thing as a commodity if you can provide best quality, remarkably the best quality and lead times and on-time delivery. You've just now delineated yourself from everybody else, and you're no longer a commodity, even if the product itself is viewed as a commodity, right? Because availability is a big deal in a lot of these things. So we had a business, and I talk about this on a different podcast, that was a commodity product, was a temperature controller in England. It was a new acquisition. And we went from 28 days lead time to 3 days. The managing director didn't think we could do that, but we did. We did it in about 9 months. We took them, Patrick, from 30,000 units a year to 110,000 units because we had the best delivery and the best lead times. And our distributors did not have to carry all the inventory. And they get measured on GMROI, gross margin return on investment. What's their biggest investment? Inventory. Okay. So guess what they wanted to buy? And we were competing against Honeywell and Siemens, just some little company in England. And we were winning. Okay. Because they did not get the service from these bigger companies.
Right.
So even in that case, you could win by being the best guy out there with lead time and quality.
Sure.
Okay.
Sure.
And service. Okay. You know, but you just hit on something that everybody conceptually will say they're doing, but they're not.
Right.
Because the first time when they ask for what the cost of this product is, as they're talking about price, you know they're not doing it.
Hello, everyone. I am sorry to interrupt this episode of the Lean Solutions podcast, but I wanted to take a moment to invite you to pick up a copy of my Shingo Award-winning book, Avoiding the Continuous Appearance Trap. In the book, I contrast the cultures of two companies I worked for. And though each started with similar lean models, one was mechanistic and only gave the appearance of lean, while the other developed a true culture of continuous improvement. The contrast provides a vivid example of the difference between fake lean and true lean. You can find the book on Amazon. Simply search my name or the title of the book. You aren't a reader? No worries. The audiobook is also available on Audible. Now, back to the show. Absolutely. And that's, I think that is definitely an issue for a lot of companies. You know, to your point, they're overpriced because they're pricing based on all their inefficiencies and all the issues that they have, rather than offering, you know, increasing the value for the customer and making sure that the customer understands the value and will be willing to pay more. So there's like this script, the script needs to be flipped with an understanding in that way. I just remember a company that I worked with. I think I've talked about this before, but they were competing for a job with one of their customers, and their price was way too high. And they're like, "Hey, can you guys come in and look at this and figure out why we're priced so high, and in comparison to our competitors?" And so we went in and took a look at this assembly line, which had, I think there was like 21, 22 people in this little, you know, maybe 10 foot by 20 foot assembly line, you know, 21, 22 people that are, you know, packaging, assembling, doing all this stuff. And I'm like, you know, wow, that's a lot of people for the output that you have going here. And we, you know, did some time studies, and we, you know, we observed the process for a while, and ended up, that was the recommendation was, you know, we need to figure out how to do this with less people, this particular job. And they weren't willing to do that. Unfortunately, they lost that job. But that's what I was thinking about that. I'm thinking to myself, first you have to look at the inefficiencies that you have, the waste, and try to drive that out, reduce that, so that you can do that specific example. If we could do that with half the people, now all of a sudden that allows us to, you know, maybe have, you know, more profit in that scenario, and still price it maybe at a, you know, where we need to in order. But, you know, we have to make sure the value's there. We have to reduce our own inefficiencies, and then, the profit will come. But
You know,
yeah,
when they say
it's
to you, we want to find out why our price is too high, my first question would be, well, who set the price?
right,
You did.
right.
And the reason why it's too high is because you set it too high. That's why it's too high. You know, and what people don't understand is that you can't, when you don't get a sale, that's zero. You cannot deposit that in a bank. It's zero. You lost the business and it's gone. So do you make a lower margin? Because again, I can't take percentages to the bank either, gross margins, let's say. But or do you get the business and continue to work on your cost position to make more profit?
Mhm.
Because otherwise zero is zero, and that customer goes away. The probability of getting that customer back is really, really tough.
Mm.
So
You
how,
know.
Mark, in talking about this concept, what I'm thinking about is like for me, I'm just kind of thinking consultants or those that are in the lean community, lean practitioners. How do they come about that? How do you make this suggestion? Is there kind of a side door to come in on when you have such a strong history of standard accounting or cost accounting, traditional, whatever, however you want to name it? There's such that strong fervor to hold tight to this, especially when it comes to money. People want to hold tight to those reins in the, maybe it's the illusion of control. How would someone like myself, or maybe, if they're embedded in the company as a practitioner, how do they start to bring this up and make this possible?
Well, you know, I don't think lean accounting or changing your accounting systems are any different than, for example, going from batch and queue to one-piece flow, okay, and reconfiguring your lines and pulling equipment together and creating cells and value streams. That's a remarkable change because you got to remember, if you go back in history, Shayne, this whole thing, the MRP work order, the Ivy White batch and queue production, all had to do with the accountants trying to control this asset called inventory, which is a very volatile inventory asset, right? It moves every day. It changes every day. There's a lot of exposure to it. And if you get it wrong, you misstate your financials, and you know what happens then. So what did we do? We created stock rooms. We created checkpoint Charlies that you have to check it in and out. We inundated the factory with unbelievable amount of transactions, okay, which are zero value added, just to track it from going to one part to another part of the factory and then back and back and back. And okay, so all of this had to do with that, the accountant's attempt to control this asset called inventory. Well, when you get to a point where inventory is inconsequential to your balance sheet or to your profit and loss statement, you no longer have to worry about it. Okay. As a matter of fact, once we, evolved at Jake Break, I got to a point where 2 years in a row, I didn't have to take a physical inventory by the auditors. Okay. What ruins that story is the auditors were Arthur Anderson. And if you think about Enron, they'll say, oh, yeah, no wonder they let you do it. Right. No, I always joke about that. But no, 2 years in a row, because our inventory was inconsequential. And they would say, well, show me your perpetual inventory. Our inventory moved too fast for any inventory to be able to document on some piece of paper. Okay. If you want to know what we have, go out and look at it because it's moving while you're standing there. Secondly, we backflushed wall to wall. So what is backflushing? I go into all the different levels of my bill of material and I make them phantom levels because you still want the integrity of the subassemblies for engineering purposes and for procurement purposes. So we didn't flatten the bill. What we did was made those levels, those subassemblies, what we call phantoms. When we had two inventory transactions, when we shipped the product, we backflushed all the materials based on the bill of material. And when we received raw materials, those are our only two inventory transactions that we had. Everything else in between, zero. Okay. So we no longer had to have production control clerks typing in a bunch of transaction tickets. Okay. And remember, all that buildup of inventory, we didn't have it. So I didn't have to account for a high work in process and labor and overhead inside. So again, guys, we backflushed from wall to wall. We had 2 inventory transactions. When we shipped it to the customer, that was 1 inventory transaction, and that would backflush all of our components all the way through the bill of material. And the other inventory transaction was when we received raw materials. That was it. The only 2 ways. We didn't have production control clerks typing in a bunch of transactions and then reconciling all the errors and all that stuff. We didn't need to do any of that anymore. It added 0 value to do that. And our inventory values were so low that if you really wanted to see what we had, just go out and look at it. It was all virtually labeled with, very clear, and you can actually see it. You can actually see it moving, So that was the idea. Well, why do I have to account for it in the interim in work in process? If it's A, inconsequential, and B, we got control over it because it's right there. I put my arms around it. I don't need a report to tell me I don't have something. Okay.
Mhm.
So to answer that question, are you saying that it's actually simpler than I'm making it out in my head if lean is done well in the organization, if we're really, bringing in those kind of principles, then the accounting side of things will actually be even maybe simple or easy to marry that up with, just because of how we're working, in the processes that we're doing. Accounting could easily follow along with that. Is that?
Yeah, and like I said, it's embarrassingly simple.
Mhm.
That's the crazy part about this, okay? But it takes what isn't simple is the big mindset shift that you have to make, especially from the CFO and the finance guys, because all they know, and you got to remember, financial people are afraid of cost accounting for the most part. Okay, they don't understand it to begin with, but now you're asking them to change something that they don't really understand. Okay, and that's kind of hard. And the good news was I had Art Byrne, George Corner-Sigrid, Bob Petlin, who's an unsung hero at Jake Brake, and at Danaher, who was a VP of operations, that were just applauding me all the way through this thing. Okay, we got rid of standard cost altogether. Standard cost. How many times have you been in a variance meeting where they're explaining not their performance, but they're explaining why the standard's wrong? Okay. Well, the reason why we're negative is because the standard's wrong.
Right.
And I'm going to spend time doing that. I mean, come on, guys. So we looked at total cost trends. Are my costs improving? That's what we're looking at.
Yeah.
Okay. Because I could let's just say I had a raw material item that cost $1 on January 1st, and it was going to be, by the middle of the year, it was going to turn to $1.50 with a price increase. So I might set the standard at $1.25. Well, the first half of the year, I'm going to be favorable. The last half of the year, I'm going to be unfavorable. Now I got to report on it every month. Okay. Well, maybe I am unfavorable, but it's being hidden by this average standard that I set the thing. Think about it. A standard cost is a budget for a product. That's what it is, which includes material labor, and overhead. It's a budget. How many budgets have you guys set, whether it be at the state of Nebraska, Shayne, or any other client that you guys might have, that were exactly equal to your actual costs? Never.
Never.
Okay. Never. And so when you look at a standard cost, it creates such minutia and does not really, support, Patrick, the PDCA, the Plan, Do, Check, Act mindset.
Mhm.
It's more along the lines, what it really fosters is plan, do, check, explain.
I like
Not plan, do, check, act. Okay.
Right.
I mean, really, that's what it does. And it's a big waste of time.
It is. And you've hit on standard costs, just kind of, it's woven through the conversation. And I want to,
sure.
Kind of pause on there and maybe ask you to expand a little bit. But I want to talk specifically about those organizations that are out there that have already embarked on their lean journey. Maybe they've been on a lean journey for a few years. Maybe they just started, but they haven't looked at their accounting practices yet. do you think that, I mean, standard accounting, using, standard costs, I mean, is it possible to be successful on your lean journey if you're still using standard costs? And I mean, what are your thoughts on that?
Yes, yes, it is, but you won't be as successful.
Hmm.
Okay. And because you're going to waste a lot of time on that. And I'd rather have my accounting group be navigators than historians. Okay. That's really what you're talking about. Okay. So if I spend a lot of time reconciling and putting together standard costs that in the final analysis mean nothing, then, here's the other thing, guys. Think about just your daily lives and how you guys would, I always like to go back to what we would do personally. And would we do these things if it was our own personal, well, first of all, you wouldn't go out, Shayne, and buy 6 months worth of groceries.
Correct.
A, where are you going to store them? B, it's a cash flow issue, even if you save
Right.
money. Well, we do it in business, right? I'll tell you a quick little story here. I was with the CEO and the CFO of this multi-billion-dollar company, and we were walking through one of their plants down in Arkansas. And as I'm walking through the plant, I said to the CFO, "Hey, how do you guys compensate your people out here?" They said, "Everybody gets measured on machine uptime." Machine uptime. Oh, okay. So right there, red flags went off, And I said, "Well, why do you do that?" And the CFO said, "Well, we paid a lot of money for this equipment. We want to make sure we get a return on investment." Now, that sounds reasonable, right? That doesn't sound like anybody would argue with that.
Mm-hmm.
So I said, "Well, how do you take return on investment to the bank?" Because what was happening here is they were not doing frequent changeovers. Like I said earlier, they're all making product A. No incentive to change over to B. Customers were calling, they were losing business because they weren't delivering B and C and D. They kept making A. The obsolescence went through the roof. They weren't doing preventive maintenance, never mind TPM, but just preventive maintenance, because that took time to take away from their compensation measure. And I said to the CFO, I said, "Hey, by the way, you just told me the other day you bought a brand new car." He goes, "Yeah, I did." He said, "I bought a Lexus. That's a good choice. They're good cars. I've owned them before, even though I'm a BMW guy." Uh, and I said, "That's a great car. So let me ask you a question." I said, "You paid a lot of money for that, right?" He goes, "Yeah, pretty expensive, but it's worth it. Resale value. Okay, good. When you go home tonight, are you going to drive that car around the block a few hundred times just to get utilization out of it?" "Well, why would I do that?" "I don't know. You're the one that told me you do it here. Why wouldn't you not do it yourself tonight with your Lexus?" And the answers are obvious, right? Why he wouldn't do that.
Right.
And he finally said, "I never heard it that way before." I go, "Look, these machines are a sunk cost. You can't get their cost back." Okay. Now, I'm not saying you'd be foolish in how you utilize this equipment, but we should be trying to make product to tack time and actually try to mirror our production plan as close as possible to our demand plan. Okay. When you make all A's, that's not how your customers order. They ordered A, B's, and C's. Okay. So they didn't order the way you decide to produce. So no, you guys got to get better with changeovers, be more flexible, and all that kind of thing. This is where high junker level scheduling comes in, is on the bottom of the TPS house, right? See how all this stuff ties together?
Yeah.
At the bottom of the TPS house, standardized work and Kaizen. Well, I can't really marry exactly my demand plan to my production plan. Okay, well, why not? Let's understand why. And there ensues my Kaizens, right? Okay, maybe it's a quick changeover Kaizen that I need to do. Maybe it's how I think about standardized work and mixed model production and all that good stuff, right? But this all ties back to that, and it's hard to talk about any one of these things in isolation because lean is one big Venn diagram.
Right. I love that. And it kind of ties back to what we were talking about earlier, because so many companies are they just think like, well, these are our costs. This is what it is, what it is. This is the way we do business. This is our changeovers are 2 hours long. Our, machines run at 50% OEE or whatever. It is what it is. So let's base all of our a business on that. Is that the mentality, or is it what you said? Why are our changeovers an hour long? Of course, I wouldn't want to when we talk to setup techs and operators about increasing the number of changeovers so we can reduce inventory, they look at us like we're crazy, because they're like,
Exactly.
you're going to increase the number of 2-hour changeovers. You know how terrible those changeovers are. Exactly. So you can't think about it that way. You have to start by thinking about, well, how can we improve the changeovers? Let's reduce these down. Let's start running some SMED events and get these down to under 30 minutes and remove some of the headaches and the problems of you looking for tools and having to walk over to the other side of the plant 15 times during a changeover. Let's get rid of some of that. Now we have shorter changeover, and then it's a lot easier sell to have a conversation about what increased changeovers might look like.
There's a high incentive for a NASCAR driver or a Formula One driver to have like a 3-second changeover, okay? Because we got to get that operator back on its work sequence, which is the racetrack. I like to use analogies. One of the examples I would use on changeover, and I have used before, is I'd say, and people can't understand, well, why do I have to do more changeovers? Because the old Ali White EOQ measure says do less, right? And optimize your economic order quantity. Well, if you're not thinking about an economic quantity of one in a one-piece flow environment, then you're thinking about the wrong way. Not that you're going to get there overnight, but the example I like to use is I'd say to anybody for that matter, how many people had a barbecue in their backyard? And they all raise their hand. And okay, you're making hot dogs and hamburgers. You got 20 guests, friends and family. How many of you guys just make all the hamburgers first on the grill? Nobody raises their hand. Oh, that must mean you do all the hot dogs, right? No, we put hot dogs and hamburgers on the grill at the same time. Well, why? Because we want people to eat together. We have demand for hot dogs, we have demand for hamburgers. And if you're like me, I like both, so I'll have one of each. But, you don't want the people who want hamburgers to eat in isolation from the people who want hot dogs. You want them to eat together. Well, show me an order. Geez, this machine makes 12 parts. There's 8 of them on here that they're asking, and they're all asking for these on the same day. So why are you making 1 part per week and changing over on the weekends? Now that we just took your changeover time by 75% in 3 days, by the way, you should be able to make each one of these parts every day, but not in the same quantities because your demand's different, right? And so you bring it back to everyday life and it starts making sense to people, But we're incentivized the wrong way, Patrick and Shayne, not to do that, because you mentioned OEE. To me, OEE, I don't like that measure because it has the same effect as absorption accounting. Exactly the same effect. How do I get the best OEE? I just run my equipment and I don't shut it down and I don't do changeovers, right? That's how I get my best OEE. Now, if people really understood OEE, they would know that that's not the right way to think about it, but that is how most people get measured. And so that's the best way for me to get my OEE is just run a bunch of stuff.
Yeah, no, I appreciate that. And it's a hard subject for those of us, like Shayne said earlier, that don't live in the accounting or the financial side of things. But I appreciate the simplicity of how you've presented it and kind of broke it down, like you said, very, very simple concepts. And I love the tie back to real life. The grill example is a perfect example. I'm grilling for my family and friends that are here. They're my customer. I want to make them happy. And so I want, in the same way within our companies, do I want to have one customer waiting while I'm building stuff for 2 other customers that aren't even going to get it for another 2 months?
Exactly.
Just trying to batch, right? No, I want to make what the customer needs and make sure that they're happy so that we're maximizing the value for the customer first.
Patrick, this is another thing you're bringing up here is this is why this has to be an enterprise endeavor, because a salesperson and I had this experience with many clients, but they get compensated on shipments. Okay. So instead of going to that customer and saying, well, you just ordered 50,000, knowing that customer needs 10,000 a month for the next 5 months, the order goes to manufacturing for all 50,000, right? Which obviously violates just-in-time principles and all that good stuff. So this is why the enterprise endeavor, that's mirror and mirror that causes, right? Then it causes a bunch of muda. Mira being unevenness, Muri being unreasonableness, if you will, and or overburdening. And if you think about it, the sales group now is not in concert with what's going on the factory floor. So here you got guys out there trying to level load and one piece flow just in time, and they come in with a batch order like that that violates just in time principles. Okay. So an easy way to change that is to change the sales compensation and base it on orders, not based on shipments. Okay. Because this is the case where anytime you try to optimize a function, in this case sales, and have that function win, most likely you're going to sub-optimize the enterprise. And that's not good. So everybody has to be in concert with the same set of objectives. And otherwise you're not going to win.
Sure.
You know, and so
that makes sense. And obviously this is also a very heavy subject too, with a lot of intricacies and details and different pathways that we could go down. So we almost need to do like a 4-part series on this, you know, and get into some of the other details that go along with it. But
questions for some of our questions.
Right. I know that's the problem. We're kind of out of time here, but Mark, I appreciate you coming back on the show for the second time. We'd love to have you back again to talk, you know, more about.
Absolutely. I'd love to help you.
But before we close up though, Mark, I know we talked about this last time. Real quick, can you just give our listeners talk about the nonprofit, the nonprofit work, the charity work that you do with veterans, and just kind of put a plug out there for that real quick?
Yeah, and I know that you're a veteran. Shayne, are you a veteran? I don't know if you
No,
served.
sir.
Well, I know we have a Marine here, and I don't want to say you were a Marine because you always are going to be one.
That's right.
And we thank you for your service.
I appreciate it.
But yeah, many may or not know, may not know, I'm a Gold Star father. I lost my son got killed in Afghanistan in 2010, and as I started, and my other son served there at the same time. By the way, they were both in the infantry. They both left CPA firms to go fight in the infantry. Did not want to become commissioned officers, so they were NCOs. Anyway, long story short, my son was killed in 2010 in Afghanistan. He was shot by the Taliban. They got ambushed. But as I started learning about the plight of our veterans coming back, and especially those trying to enter industry, or you know, corporations and all that. And you know better than me, Patrick, the military is very regimented, very standardized, very black and white in terms of your responsibilities, who you report to. Everybody knows if you didn't get it done, it's very obvious. And they come back into these supposedly well-oiled corporations, at least that's what their CEOs say, and they see a sea of gray. Okay. And they have a lot of trouble functioning. And there's a trust issue too, because the people that they were with, even if they hated the guy next to them, they know that person had his back. Now you come back here and you got all this politics and games, and the trust issue to me is probably the biggest issue that that veterans have. And I can't fix that, but what I can do is help them either navigate their careers, or many of them come to me and say, "Hey, I want to start a business." And first thing I do is I try to talk them out of it, okay, to make sure that they really have the DNA to do this.
Sure.
So my organization, and it's not a nonprofit because it's I don't take any money for it. It's all just based on time and help. And I write strategic plans and financial plans. I'll go to a bank and get a loan and make an investor presentation or whatever it is. But it's called BRAVE, BRAVE, and it stands for Business Reviews and Advisors for Veteran Entrepreneurs. And the website is forthebrave.org, the number 4, thebrave.org. And what I try to do is just help our veterans transition because, you know, I'm stealing this phrase, but as you know, Patrick, I think we do a pretty good job helping our military put on the uniform. But as a country, we do an awful job helping to take it off. And that goes from healthcare to the veteran. I was just on a call the other day with a Marine from Vietnam who is a good friend of mine. I ran for Congress. I met a lot of good people and people are just dying in our VA hospitals based on negligence and in some cases corruption. And I just look at how we treat our veterans after they get back. And the only time you really hear about it is when politicians are running for office, and then it gets forgotten for 2 years. The homeless is insurmountable. The suicide rate is, as I'm sure you know, and probably know people
Yeah.
who are no longer here. I just think our country does a horrendous job at taking care of our veterans. So I asked myself after my son died, I didn't serve. I missed Vietnam by about a year. And not that that's an excuse, but I didn't serve. And I said, well, what can I do, to offer help for them, right? Geez, God's given me a bunch of gifts. I know they're on loan. They're not me. The experiences I had being at the right place at the right time with Danaher, at Jake Brake, working for guys like George Konensaker and Art Byrne, how the hell lucky can you have gotten, right? And so I know all these gifts that I got, the experiences and even the mistakes were all gifts. And if I don't do something with those gifts, then to me that's a sin, right?
Yeah.
That's why I do it. So
yeah, love it, love it. Well, we're going to drop a link to that in the show notes, along with a link to links to your books and your website. So we'll make sure that all that is in the show notes. But you definitely raised a couple of good boys there. So good on you there, and appreciate what you're doing with Brave.org.
yeah, but Steven, the one that got killed, his name was Steven. He was 25. Scott was 28 at the time.
Mm-hmm.
The only failing I have is he grew up to be a Yankee fan. Okay. And I'm a diehard Red Sox fan. Okay. So that was my one failing in life. So as a father, anyway.
Love it. Love it. All right, Mark. Well, we're going to close up here. Thanks again for your time again today, and just appreciate you. And if anybody has any questions, feel free to reach out to Mark on LinkedIn or at his website. I'm sure he'd be happy to answer.
Yeah, the best way. I'm not on LinkedIn. When I was running for Congress, they kicked me off for telling the truth about a couple of things. But you can get me at mark@leanhorizons.com. I'm Mark.DeLuzio. I'm sorry. Mark.DeLuzio at leanhorizons.com. Be happy to answer questions. You guys want Shayne, you want to come back and do some more follow-up on this? I'd be happy to come back to you guys. So
love it. We'd love to have you on for sure. Thanks so much for tuning in to this episode of the Lean Solutions Podcast. If you haven't done so already, please be sure to subscribe. This way you'll get updates as new episodes become available. If you feel so inclined, please give us a review. Thank you so much.